Have you ever wondered how the ultra-wealthy seem to get richer even when the economy is crashing around them? While most people are losing their jobs, watching their savings disappear, and struggling to make ends meet, the rich appear to have some kind of magical shield protecting their wealth. Today, we're going to pull back the curtain and reveal the secret sauce that allows the wealthy to not just survive, but thrive during economic turmoil. The truth is, it's not magic at all. It's a combination of strategies, mindset shifts, and tools that most people either don't know about or don't understand how to use effectively. By the end of this video, you'll have a complete roadmap of how the rich stay wealthy during tough times, and more importantly, how you can start implementing these strategies yourself. Let's start with the most fundamental principle that separates the wealthy from everyone else during economic downturns. They think in terms of assets, not just income. While most people focus on their monthly paycheck and worry about job security, wealthy individuals have already built multiple streams of income through assets that continue to generate money regardless of what's happening in the broader economy. Think about it this way. If you own rental properties, those tenants are still paying rent even during a recession. If you own dividend-paying stocks in essential industries, those companies are still distributing profits to shareholders. If you have a business that provides necessary services, people still need those services even when times are tough. The wealthy understand this fundamental difference and spend their time and money acquiring assets rather than just working for a paycheck.
But here's where it gets really interesting. The wealthy don't just buy any assets, they buy assets that actually benefit from economic turmoil. This brings us to our second secret. They invest in recession-proof industries and counter-cyclical assets. While everyone else is panicking about the stock market crashing, smart money is flowing into sectors that actually do better during tough times. What are these recession-proof investments? Dollar stores, for example, often see increased sales during recessions because people trade down from expensive retailers. Discount retailers, debt collection agencies, and certain healthcare sectors also tend to perform well. The wealthy know that when people have less money, they look for cheaper alternatives, and they position themselves to profit from this shift in consumer behavior. Precious metals like gold and silver have historically been safe havens during economic uncertainty. When currencies become unstable and inflation rises, these tangible assets often maintain or increase their value. The wealthy allocate a portion of their portfolio to these assets, not necessarily for huge gains, but for wealth preservation during volatile times. Here's something most people don't realize. The wealthy actually look forward to economic downturns because they represent the greatest wealth-building opportunities. This is our third secret. They buy when others are selling. Warren Buffett famously said, "To be greedy when others are fearful." And this perfectly captures how the wealthy approach market crashes. During the 2008 financial crisis, while most Americans lost trillions in wealth, the wealthy were buying up foreclosed properties, purchasing stocks at massive discounts, and acquiring businesses that were struggling but fundamentally sound. They understood that economic cycles are temporary, but quality assets bought at the right price can provide decades of wealth building. The key is having the cash available to take advantage of these opportunities. This leads us to our fourth secret. Wealthy individuals always maintain significant cash reserves. While conventional wisdom suggests keeping 3 to 6 months of expenses in emergency funds, the wealthy often keep much more. They understand that cash is not just for emergencies, it's for opportunities. When everyone else is leveraged to the hilt and forced to sell assets at fire sale prices, the wealthy have the cash to be buyers. They don't see cash as a dead asset earning low returns. They see it as ammunition for the next big opportunity. This patient approach to wealth building is what allows them to consistently buy low and sell high, while others are forced to do the opposite. Let's talk about the fifth secret. The wealthy understand and use leverage strategically, but they also know when to reduce it. During good times, they might use borrowed money to amplify their returns on investments. But as economic conditions deteriorate, they systematically reduce their leverage to protect their wealth from margin calls and forced liquidations that destroy so many investors during market crashes. This is completely opposite to what most people do. Average investors often increase their leverage during good times and are forced to sell everything during bad times. The wealthy do the reverse. They reduce risk when times are good and increase their risk when prices are low and opportunities are abundant. Here's a secret that might surprise you. The wealthy spend significant time and money on financial education and professional advice. They understand that managing wealth is a skill that requires continuous learning and expertise. They hire teams of financial advisors, tax professionals, and investment managers who help them navigate complex financial strategies and identify opportunities that most people never even hear about. This isn't just about having more money to pay for advice. It's about understanding that financial education is an investment that pays dividends for decades. The wealthy read financial publications, attend investment seminars, and constantly educate themselves about new strategies and opportunities. They treat wealth building like a business, not a hobby. Our seventh secret involves tax strategies that most people don't understand or utilize. The wealthy structure their investments and businesses to minimize tax liability, especially during economic downturns when they're buying assets at discounted prices. They understand concepts like tax loss harvesting, where they sell losing investments to offset gains and reduce their tax burden. They also use sophisticated structures like trusts, limited partnerships, and other vehicles that not only provide tax advantages, but also protect their wealth from creditors and legal challenges. These structures might seem complex, but they're essential tools for wealth preservation during uncertain times. The eighth secret is geographic and currency diversification. Wealthy individuals don't put all their eggs in one basket, and that includes countries and currencies. They often have assets in multiple countries, bank accounts in different currencies, and sometimes even multiple residences or citizenships. This protects them from country-specific economic problems, currency devaluations, and political instability. If one country's economy crashes, they have assets elsewhere. If one currency becomes worthless, they have others. This level of diversification requires significant wealth to implement effectively, but it's a key strategy for protecting wealth during global economic turmoil. Here's our ninth secret. The wealthy invest in themselves and their networks. During economic downturns, they don't just hunker down and wait for things to improve. They use the time to improve their skills, expand their knowledge, and strengthen their professional relationships. They understand that their most valuable asset is often their ability to create value for others. They might go back to school, learn new technologies, or develop new business skills. They invest in their health, knowing that physical and mental well-being directly impacts their ability to make good decisions and capitalize on opportunities. They also cultivate relationships with other successful people, understanding that many of the best investment opportunities come through personal networks rather than public markets. Finally, our 10th secret is perhaps the most important. The wealthy have a long-term perspective and emotional discipline. They don't make financial decisions based on fear or greed. They have predetermined strategies and stick to them, regardless of what's happening in the news or how they're feeling on any given day. This emotional discipline is what allows them to buy when others are selling and sell when others are buying. They understand that markets are cyclical, that economic downturns are temporary, and that the greatest wealth is built by those who can remain calm and rational when everyone else is panicking. They also understand that building real wealth takes time. They're not looking for get-rich-quick schemes or trying to time the market perfectly. They're building systematic wealth through consistent application of proven strategies over decades, not months or years. So what does this mean for you? How can you start implementing these strategies even if you're not already wealthy? The key is to start where you are with what you have. Begin building your emergency fund so you have cash available for opportunities. Start educating yourself about investments and financial strategies. Look for ways to create multiple streams of income through side businesses or investments. Most importantly, start developing the mindset and emotional discipline of the wealthy. Stop thinking like someone who just works for money and start thinking like someone who makes money work for them. Begin viewing economic downturns not as disasters, but as opportunities to build wealth at discount prices. The secret sauce of the wealthy isn't really secret at all. It's a combination of knowledge, strategy, discipline, and patience that anyone can learn and implement. The question isn't whether these strategies work. The question is whether you're willing to put in the time and effort to master them. Remember, every wealthy person started somewhere. They learned these strategies, developed these habits, and built their wealth over time. You can do the same. Start today, start small, but start. Your future wealthy self will thank you for taking action now, instead of waiting for the perfect moment that may never come. The next economic downturn is coming, that's guaranteed. The question is, will you be one of the people who loses wealth, or will you be one of the people who builds wealth? The choice is yours, and now you have the roadmap to make the right decision.